Hello, what's up guys? Welcome back to the channel, and this is your guy Franklin Emmanuel. In this video, we are going to be taking a deep dive around understanding cryptocurrency from scratch. Yes, so if you're a total beginner, we actually started off a particular video where I was breaking down everything cryptocurrency and giving you insight on how you can actually get to be more conversant with all of those crypto lingua, so that you can start making better crypto decisions, so you don't get scammed at all in your crypto journey. As a beginner, I understand you need these things in order to carry on. I was like that, and it was a little bit difficult for me to actually just pick up my feet on the ground and start making better decisions in crypto. But understanding everything around the cryptocurrency and their linguas, you are most probably going to be able to start doing better and making better decisions, at the same time getting better ROI with every of your investments. Okay, so let us continue. So if you're actually watching this video, this is the part 2. Let's actually continue, but just know that there's a part 1 which you most probably want to also watch. It's on the channel already, so click the link in the description or just visit part 1 right here, watch it and come and continue with this one so that we can actually flow. At the same time, there's going to be a timestamp on every of this, so that you're able to follow through and you can skip whatever it is and all. Alright, so we actually have atomic swaps, and atomic swaps basically are like trustless trades between two parties. Imagine you and a friend each actually have a rare baseball card that each other wants. An atomic swap would be putting both cards into a magic box, then unlocking it and completing the trade when both parties finally agrees. In the crypto world, atomic swaps allow two people to trade different cryptocurrencies directly without needing the trust of a third party like an exchange. The trade either happens in full or not at all. There is no risk of any party not holding up to the end of the deal. This is actually made possible by smart contracts, which are self-executing contracts with the terms of agreement directly written into code. Now let's take a look at decentralized application, dApps. dApps are actually like the apps on your smartphone, but instead of being controlled by a single company, they run on a decentralized blockchain network. Now imagine if Facebook was not run by Mark Zuckerberg and a company, but by all of its users collectively. That's the idea behind a dApps. And they are actually more of an open source, decentralized, and often they even incentivize users to maintain and improve that particular network. Now the most popular platform for dApps is currently Ethereum, but there are many other blockchain networks that actually support dApps development. Next, let's look at non-fungible tokens, NFTs. I'm sure you must have heard about that, and I heard people actually making big bucks in that area. So non-fungible tokens are like digital collectibles. They are unique digital assets that are verified on a blockchain. Now imagine if you had a digital trading card that was absolutely one of a kind and you could prove it. That essentially is an NFT, and that's what an NFT is. Now, an NFT can actually represent all sorts of digital items, from art, music, videos, and even virtual real estate in online games. And just like physical collectibles, their value can soar if they are rare and high in demand. Now, let's look at decentralized finance, DeFi. Now, DeFi is like if you could do all your banking without actually needing a bank. Yes, with DeFi, you can actually learn, you can borrow, you can trade, and even invest using decentralized applications on the blockchain networks. And there is no central authority controlling your funds, and you have complete control. Now imagine being able to take out a loan without needing to go through a credit check, or being able to trade stocks without paying a hefty brokerage fees. This is actually the potential of DeFi. Let's also look into cryptocurrency mining pools. And these are like joining a lottery pool with your co-workers. Instead of buying lottery tickets individually, you pool your money to buy more tickets and agree to share the winnings if any tickets hits. In crypto mining, a mining pool is a group of miners who combine their computing power and agree to share the rewards proportionally to their contributed power. Now this way, instead of competing against each other, miners actually work together and have more steady stream of income, even if it's in a smaller amount than if they mine solo and hit block rewards on their own. Now let's also look at the cryptocurrency consensus algorithm. The cryptocurrency consensus algorithm are like the different rules for different sports. Just as basketball and football have different rules for scoring points and winning the game, different cryptocurrencies have different rules for validating transactions and creating new blocks. Proof of work is like a sprint, and the first miner to solve a complex maths problem gets to add the next block and receive the reward. Bitcoin uses POW, that's proof of work, and proof of stake. This is actually more of like a raffle, and the more coins you hold and stake, the higher your chances of being selected to validate the next block and receive reward. Ethereum is moving towards the POS model. And there are many other consensus algorithms, each with their own pros and cons in terms of security, scalability, and decentralization. Now let's look into cryptocurrency airdrops. Airdrops and faucets are like free samples in the crypto world. An airdrop is when a blockchain project distributes free tokens or coins to the crypto community. It is often done to create a new awareness for a new cryptocurrency. Now imagine walking down the street and someone hands you a free sample of a new product. That is basically what an airdrop is in the crypto space. A faucet basically, on the other hand, is a website or an application that dispenses small amount of cryptocurrencies for free, usually in exchange for completing a small task. It's like those websites where you can earn small amounts of gift card or cash for completing surveys and watching ads. While it can be fun in a way to get started with crypto, it is important to remember that there is no such thing as free money. Always be cautious of any offer that seems too good to be true. Okay, so now let's look at cryptocurrency halving. Now, cryptocurrency halving is actually like a scheduled pay cut for miners. Now, imagine if every 4 years your salary was cut in half. That is essentially what happens to the block reward in cryptocurrencies like Bitcoin. The idea behind halving is to control the supply of new coins entering circulation by cutting the block reward in half every 210,000 blocks, roughly every 4 years for Bitcoin. The rate at which new coins are generated slows down over time, and this is part of Bitcoin's deflationary model. There would be only 21 million Bitcoins in existence, and the last one is projected to be mined around the year 2140. Now, the last Bitcoin halving event actually held, about last week, a week ago, and it was really an awesome experience. We're actually hoping for more now that it's post Bitcoin halving. Now let's look at dollar cost averaging, DCA. DCA is like a saving plan for your crypto investment. Instead of trying to time the market and buy at the perfect price, you invest a fixed amount at regular intervals, regardless of the price. Now imagine deciding to buy $100 worth of Bitcoin every month, no matter if the price goes up or down. Some months you will get more Bitcoin for $100, and some other months you get less, but over time you would average out the price you pay. Now DCA is a strategy that can actually help take the emotions out of investing and mitigate the impact of volatility. It is a popular approach for long-term crypto investors who believe in the future potential of the assets. Now, you might have actually heard about cryptocurrency testnet. What is it? And let's look into it right now. A testnet in cryptocurrency is like a training wheels version of the real thing. It's a network that operates just like the main network, but the coins have no real value. Now, testnets are used by developers to test new features, upgrades, or applications without risking real funds. They are also used by users to practice using the network without the pressure of dealing with real money. Most major cryptocurrencies have a testnet. For example, Bitcoin has the Bitcoin testnet, and Ethereum has the Ropsten, the Kovan, and Rinkaby testnet. Now let's take a look at this big guy, this big elephant in the room. This is the crypto Ponzi scheme. The Ponzi scheme basically in cryptocurrency is like a game of hot potato, but with money. It's a fraudulent investment scheme where returns are paid to either investors with funds from the later investors. We all know what Ponzi is, right? So let me not even take much of time to explain what this is, but it's exactly the same way it happens on here. Okay, but then guys, the big question here is, how do you spot this cryptocurrency Ponzi schemes? One is where the Ponzi schemes promise high returns with little or no risk. They actually use complex jargons or claims to have the secret investments and all. And in the end, if you are just sitting on a pile of carton boxes, all right? Whatever it is, but we all know what Ponzi schemes are. They're no good area, except you are really ready to just, dash in and dash out and you're good to go, okay? And finally, this one that actually gets to trick out a lot of people, the pump and dump scheme. The pump and dump scheme in cryptocurrency basically is like a game of musical chairs, but with investment. This is a form of market manipulation where a group of people coordinates to artificially inflate the price of a coin. That's the pump. Then they get to sell their holdings at a higher price, which is now the dump. And this basically causes the price of this particular cryptocurrency to crash. Do you get? Okay, let me explain further. Hold on. Now imagine a group of people agreeing to all buy a certain low value coin at the same time, causing the price to suddenly spike. Okay, and this basically will now attract a lot of more investors who are actually seeing this sudden value on the coin, and immediately they actually jump in and they invest more. The value still goes higher, right? Because there are more investors coming in. Now, these first groups of guys go ahead and then they sell the coins at a way higher value, and it dumps, right? Because a lot of people are now selling, this group of guys are now selling, and the value drops again. And you who actually invested afterwards would actually be getting way lower of value for your money. Okay, so that's it. Now, pump and dump schemes are basically illegal in the traditional financial market, and are also considered a form of security fraud in the largely unregulated crypto market. However, they are unfortunately common, particularly with small and low volume coins. All of those meme coins, there are a lot of them there. Now, this is another set of series of cryptocurrency lingua you must actually be very conversant around, and I'm really hopeful that you're able to take all of this and you master them, and you can get to keep them as well into your knowledge around the whole cryptocurrency space and all, so that you can make the most out of this. Okay, so this is it for this video today, guys. Let me know what you learned in the comment section below, and thank you so much, guys, for this video. I'll be seeing you in the next. Peace.